Hi friends, we have been hearing the news about Indian rupee depreciating. Let's understand why is it depreciating and how the RBI is fighting speculators to stabilize the rupee. Every time US-Iran tensions flare up, like the latest threat where the American president said he would bomb Iran back to Stone Age, global markets start to sweat. Oil prices shoot up, stock markets fall, bond yields increase. In fact, nothing is left behind. And India, because of its heavy dependence on the Middle East for oil, trade, and remittances, is one of the first economies to feel it. That's why, over the last few days, the Indian rupee has once again started showing visible signs of depreciation. Just in March alone, the Indian rupee depreciated over 4% for the just concluded financial year 25-26, the Indian rupee fell about 10% against the dollar. The core idea of this video is to understand if the depreciating rupee is always bad or is there anything good in it. Now let's get to the core of the video. Why is Indian rupee falling? The foreign portfolio investors are exiting India, and in 2025 they sold Indian stocks worth US dollars 19 billion. Crude oil price is increasing and many of our imports are getting expensive, that is widening trade deficits. Dollar is strengthening. This also adds to the falling of or depreciation of the Indian rupee. What is RBI doing to prevent this depreciation of Indian rupee? RBI does its usual act of selling US dollars from its FX reserves. Recently, it has asked banks to limit their daily net open positions on the rupee in the foreign currency market to $100 million. It has also prohibited banks from offering non-deliverable derivative contracts involving the rupee. So we have to understand these two terms. Daily net open positions on the rupee in the FX market. Think of bank as a big middleman. When your company exports something, it gets paid in dollars. Think about Infosys, TCS, etc. Infosys walks to the bank and says, I have US dollars with me. I want rupees to pay my employees. The bank buys USD from Infosys and pays rupees to them. On the other hand, when your company imports something, it needs dollars. Think of IOCL or any other petroleum company in India. IOCL goes to the bank and says, I have rupees, I want USDs to buy crude oil. The bank sells USD to the importer. So all day, the bank is buying USD from the exporters and selling USD to the importers. Now imagine the bank isn't perfectly balanced. Suppose at the end of the day, the bank buys 1,100 million from Infosys but only sells 1,000 million to IOCL. That is, at the end of the day, the bank is left with an additional dollar amount of $100 million. RBI says that this dollars should be hedged. Hedge means there should be an agreement with someone who agrees to give a fixed rupee for this dollar. That is, if the dollar suddenly goes up or down, the bank can either gain or lose a lot. So through this agreement, through this hedging, it is trying to avoid that risk. But sometimes banks choose to leave that 100 million unhedged. Why is that so? Because the bank believes that the rupee will depreciate even further. For example, let's say today 1 USD is 90 rupees. If the bank hedges now, that is, it agrees with someone who agrees to buy its US dollars, who agrees to buy the bank's US dollar for 90 rupees. But if the rupee falls to 95 tomorrow, then that same dollar would be worth 95 in the market. So when IOCL walks in the next day and says we need $100 million to buy the oil, the bank can actually sell those dollars at a higher rate and collect more rupees, 95 rupees, than it would have if it had hedged earlier, where it would have got only 90 rupees. This kind of unhedged dollar pile is what we call a net open position. On top of this $100 million that the bank is left with, it may also additionally buy more dollars just for betting purpose. And since the bank is betting against the rupee, it is called net open position on the rupee. RBI has asked the banks to limit their daily net open positions on the rupee in the foreign currency market to $100 million. This forces banks to either sell extra USD or hedge it instead of sitting on a big long dollar bet. This process takes place inside India. RBI wants the banks to focus on genuine hedging, like the exporters, importers, corporates, not on enabling currency speculation. Now, the next term is non-deliverable derivative contracts involving the rupee. This takes place outside India. This has nothing to do with Infosys or IOCL trading dollars for trade-related purpose. This is for pure betting or speculation process. As the name suggests, at the expiry of the contract, no goods or no service is delivered. Instead, the two parties just settle the difference amount in USD. Suppose today in India, that is in onshore market, $1 is 94 rupees. But in the offshore forwards market in Singapore or London, because traders expect the rupee to fall further, the forward price is 95 rupees for $1. In other words, the offshore rupee is priced weaker than the onshore rupee. Now imagine an Indian bank that wants to bet on rupee depreciation. Here is what it can do. In Singapore, that is in offshore market, the bank sells $1 at a forward rate of 95 rupees existing in that market. That is, it is promising to give 95 rupees for $1 tomorrow to the other party. In future, if the actual rupee value is lower than 95, that is, it goes beyond 95 to 96, 97, etc., the other party gives $1 to the bank and the bank gives 95 rupees as promised. But if the bank immediately sell the $1 it got from the other party in the spot market, it will get more than 95 rupees that it has given to the other party. So the bank earns a profit. In addition to this profit, back in India, the bank buys that same USD today at 94 rupees in the onshore spot price. If it has sold $100 in the forward market in Singapore, it will buy $100 in India at a lower price. This is like buying a banana for 94 rupees today and selling it tomorrow for 95 rupees in Singapore. Each time the bank does this, that is, it buys US dollars in India, then that increases the demand for dollars in the domestic market, and more demand for dollar pushes the rupee down. That is, the rupee will be depreciated. When the rupee depreciates in this manner, the offshore forward rate also adjusts again. Say the offshore market that was trading at 95 rupees, now it is trading for 96 rupees. $1 is available for 96 rupees in the future. When the price becomes 96, the bank's first contract is already in a profit now, what it has already given to the other party. Now in Singapore, the bank again sells another $1 at a forward rate of 96 this time. That is, it is promising to give 96 rupees for $1 tomorrow to the other party. Back in India, the bank buys the same USD today at 95 rupees in the onshore spot market. And just like that, the cycle repeats. Buying dollars in India pushes the rupees down. It sells dollars more expensively offshore and profit in USD. RBI has prohibited banks from offering non-deliverable derivative contracts. That is, this kind of thing the banks have been prohibited to do involving the rupee. These moves were success as Indian rupee stopped depreciating, demonstrating that a huge speculative buildup existed in the system. Speculation apart, Indian rupee has a depreciating tendency due to the fundamental factors like balance of payment deficits. Additionally, Indian rupee is not just depreciating on nominal terms but in real terms also. Nominal exchange rate is what gets quoted on the screen usually, like $1 is equal to 89 or 95 or whatever. So when rupee falls against USD from 80 to 90 rupees, the depreciation of the rupee in nominal terms is 90 minus 80 by 80, which is 12.5%. Real exchange rate is the nominal exchange rate adjusted for factors like inflation. So if inflation in India is higher than in the US, the rupee should depreciate in real terms, meaning the same rupee should buy fewer US price goods. Assume last year 1 USD was 80 rupees. A burger in India costed 100 rupees. A burger, that same burger in US cost $1. 100 rupees when converted to USD is $1.25. That is, you could get 1.25 burgers in the US. This year, USD is 90 rupees. Indian inflation is 20%. That is, the burger has now costed 120 rupees. US inflation. The price have risen only 5%. That is, the same burger now costs $1.05. 100 rupees when converted to USD is $1.11 now. You get 1.11 divided by 1.05 is equal to 1.06 burgers only. Nominal value has moved from 80 to 90, that is 12.5 depreciation, 12.5% depreciation, but the real purchasing power in US goods. Last year, 100 rupees, you could buy 1.25 US burger. This year, with 100 rupees, you could only buy 1.06 US burger. That is the real depreciation of about 15%, much more than the nominal depreciation of 12.5%. There is something called real effective exchange rate. Instead of looking only at USD INR, economists look at India's currency against a basket of 40 trading partner countries' currencies. REER, or real effective exchange rate, is a weighted average of those 40 bilateral rates adjusted for inflation differentials between India and each partner. The weights are determined by comparing the relative trade balance of a country's currency against that of each country in the index. It tells economists if India becomes more or less competitive in export pricing terms across all major markets. Most central banks, including RBI, set REER is equal to 100 as a long-term average benchmark. When REER crosses 100, it means rupee is overvalued, that is, our exports look more expensive. If REER is less than 100, rupee is undervalued and our exports look cheaper. REER showed that Indian rupee was undervalued by about 6% in February. This is actually a good thing because for Indian exporters, it will be the Indian assets become cheaper for foreign investors and more of Indian goods get exported. It attracts capital inflows and ultimately it leads to the improvement of balance in payment. Therefore, the currency depreciation is not always a bad thing, especially on the background of the current geopolitical situations. Thank you.